welcome back in as I see all of those who are in the waiting room are starting to come in. I hope you had a great time throughout this conference. There's been a lot of great companies, a lot of great speakers, and we've got a fantastic speaker who right now is dialing in because he is currently moving, but really wanted to be here and speak to all of you. So I appreciate that very much. We are having Rick Rule on. If you don't know who he is, you've been living under a rock, but just in case, Rick Rule has devoted over 35 years to natural resources investment. His involvement in the sector is broad as it is long. His background includes mineral exploration, oil and gas exploration and production, water, agriculture, hydroelectric, and geothermal energy. Mr. Rule is sought after speaker at industry conferences, a frequent contributor to numerous media outlets, including CNBC, Fox Business News, and BNN. It goes on and on and on. Rick, all the different times that we've spoken with each other, our community has loved hearing from you because you've been in this for such a long time and you've amassed so much experience over that time. And we're about to hear a little bit more of that as well. So I'm going to hand it over to you. Once again, thank you very much. And for everybody who's watching and listening right now, Rick Rule.
Well, I'm delighted to have the opportunity to address your audience again. So thank you for having me on. I think I have mostly good news to report today. Of course, most people on this call are probably already precious metals aficionados and have probably had a pretty good 6 months. But let's talk about precious metals and talk about natural resource investing. I'd like to begin by saying that I suspect that the people on this call over the next 5 years are not in for just one bull market, but rather two bull markets, a precious metals and precious metals equities bull market first, and then later, 2 years from now, 3 years from now, 4 years from now, a general resources bull market. And we'll go into this, but let's do precious metals first. I want to begin by saying that I really believe that the wind is in the sails of physical precious metals. The move that you have seen in precious metals didn't occur at random. It occurred for a reason. In my experience, and for those of you who don't know me, I've been involved in precious metals markets, I'm embarrassed to say, since 1970, so for a very long time. While there are many things that cause precious metals prices to move, the most important is real interest rates or negative interest rates. The most important reason that people buy gold and then later silver is because they're concerned about the ongoing purchasing power of their savings denominated in fiat currencies, particularly the US dollar, and particularly in sovereign savings instruments like the US 10-year Treasury. People are nervous about the value of their savings in these instruments, and they're nervous about their savings for very good reason. The first reason is, of course, quantitative easing. If people on this call engaged in quantitative easing, it would be called counterfeiting, and they would be put in prison. If the government engages in counterfeiting, it's called quantitative easing. It's policy, and it wins votes. So everybody needs to understand that the nature of quantitative easing, which is basically the printing up, or rather the creation by keystroke, of currency units unbacked by anything, by its very nature debases the currency. Debasing the currency reduces the future value of savings held in that same currency. The second reason, of course, is related to the first, which is to say debt and deficits. At the federal level in the United States, we have over $24 trillion in recourse obligations, which is to say we owe each other in excess of $24 trillion. But the bigger problem is the off-balance sheet liabilities, Medicare, Medicaid, the Social Security Trust Fund. What a funny name that is, trust fund. Those numbers total over $100 trillion. So people who are concerned about the government's ability to pay back bonds and the ability to service debt have to concern themselves with the fact that they're standing in line with $120 trillion in other creditors. And how do we pay that off? Of course, the national income, which is taxes and fees, less expenditures. The problem is that the national income is in deficit. In the month of June alone, the federal deficit exceeded $800 billion. That's not the annual deficit. That's the deficit in a month. I will leave it to young, smart people who I know are part of the Follow the Money constituency, how you add a column of negative numbers, which is to say deficits, and come up with a positive sum sufficient to retire $120 trillion worth of debt. By the way, the number gets worse because that doesn't include state debt, local debt, corporate debt, personal debt, or unfunded pension liabilities. So debt and deficits are a big deal. On top of that, of course, we have negative real interest rates. By real interest rates, what I mean is that the stated interest rate, the nominal interest rate, for instance, on the U.S. 10-year Treasury is about 50 basis points, 0.5%. In a currency that the Congressional Budget Office says is depreciating at 1.6% a year. So they're paying you 50 basis points in a currency that's depreciating by 160 basis points annually. In other words, your government promises you that if you entrust money to them, they will pay you back less than you lent them by 1.1% a year, cumulative and compounded. My friend Jim Grant refers to negative real interest rates as, quote, return-free risk. So it's important to know that gold and silver are competing really with instruments that offer return-free risk, not a very tough opponent to beat. And we have seen, in fact, gold and silver perform very well over the last years for that reason. The good news for those of you who own gold and silver, and the bad news for those of you who don't, is that there is a fourth reason why the wind is in precious metal sales. And that is because precious metals and precious metals related investments are way, way, way under-owned. A study that I read about 1.5 years ago suggests that precious metals and precious metals related investments constitute between 1/3 of 1% and 1/2 of the total savings and investment matrix in the United States, which is to say that less than 1/2 of investment type assets are invested in precious metals. Now, to put this in context, in 1981, which was the peak of the prior manic bull market in precious metals, the same number, the market share in precious metals and precious metals related investments was 7%. But I'm not suggesting to you that the market share of precious metals or precious metals related assets will return to 7%. The 3-decade-long mean, that is the mean market share of precious metals and precious metals related assets in the total savings and investment matrix in the United States was between 1.5% and 2%. What I am suggesting to you is that the market share of precious metals and precious metals related assets in the next 2 to 5 years will come back up to the 3-decade mean. And if that happens, demand in just the United States, not worldwide demand, but demand in just the United States will somewhere between triple and quadruple. Remember that we don't have to get back to 7%. We don't have to have the demise that so many gold bugs are talking about, the collapse of the dollar. We don't have to have any of that. All we have to do for a tripling or quadrupling of demand for physical precious metals and precious metals equity and precious metals denominated debt, all we need to do is return to the 3-decade mean, and demand for these assets increases by something like triple or quadruple. That's the circumstance I'm looking for. I think it's a fairly modest ask, and I think given the fact that the competition for precious metals is in fact return-free risk, means that my own ask may be very, very conservative. Now, in looking at the precious metals bull market, I think it's important to look at history. Later on in this call, I will talk to you about sending any of you who want a copy of a chart, the Barron's Gold Mining Index, that I'm going to refer to now. I use the Barron's Gold Mining Index because it's a fairly broad index, and it goes back about 50 years in recorded history. That is to say, it's a very long and very inclusive index. And looking at this index is very instructive in terms of understanding the anatomy of a bull market. Now, for those of you who are on the call who haven't been in prior precious metals bull markets, we had a doozy in 1970 to 1981. The gold price ran from an admittedly price-controlled $35 an ounce to a high of $850 an ounce. And in fact, silver's move was even more dramatic, from $1.50 peaking out at $50. A more modest gold bull market took place in the period 2000 to 2011, when the gold price moved from $252 an ounce to a high, if my memory serves me well, of about $1,900 per ounce. It's instructive to know that in addition to those two bull markets, there were 8 recoveries in the precious metals equities, recoveries from oversold bottoms. These recoveries occurred in bull markets and bear markets, but they were all fairly dramatic. I need to say at this point in the call that I believe that what we're into now is the third bull market of my career. But if I'm wrong, if we are merely in a recovery from an oversold bottom, the potential for that is dramatic too. The Barron's Gold Mining Index chart will show you that there have been 8 prior recoveries from oversold bottoms going back to 1970. The most tepid of those recoveries was 150%, and that's by the index, not the best performing stock in the index, but rather the entire index in the worst performing recovery was up 150%. In the best recovery, the market was up 1,100%. And these recoveries took place in periods of time as brief as 13 months and as long as 42 months. Now, my belief is that we are in a new gold bull market, precious metals bull market, which is different than a recovery. The bull markets that I have seen in my career have lasted an average of 10 years, albeit I've only seen 2 of them. And they have featured 500% or more gains in the metals and much larger gains than that in the precious metals indexes. And of course, the gains that can be had in individual stocks are really, truly the stuff of legend. But I think we have enough data in mind that we don't need to be inflammatory in terms of what happens to some individual stocks. Remember this, in a gold bull market, the price of gold really, really, really moves. People ask me now, Rick, we've gone from $1,100 to $1,900. How much further can it go? Well, again, let's look back at history. And let's not take the most dramatic example. Let's take the example the year 2000 to 2011, which I believe, by the way, wasn't as bullish for gold as this circumstance is. Remember that the gold price moved from $250 an ounce to $1,900 an ounce over 11 years. Is past prologue? I don't know. But the past certainly tells me that a move from 1,100 to 1,900 is a move that is by no means over. Remember too, and the chart shows you this very well, that the gold stocks, although they move later than gold, move further. Some internal work that we have done at Sprott suggests that the move in the gold price can be amplified 2 or 2.5 to 1 in the equities, which is to say 100% move in the metals price can occasion a 200 or 250% move in the equities. And remember too, that that's all of the equities. That is to say, it's a measurement of the index, not the best individual stocks. Now, let's talk a little bit about the anatomy of a gold bull market, because I think that's important. In my experience, and frankly, in several hundred years of recorded history, these precious metals bull markets occur, gold moves first. The sort of thing that causes gold to move, as we've discussed before, really is fear. Fear related to the ongoing purchasing power of other savings instruments. The gold buyer is a motivated buyer because he or she is a fear buyer. What I have noticed is that gold moves first, and then silver moves later. You have seen that in this bull market. The move in gold was unaccompanied by a move in silver for the first 9 months of the market. But as the momentum was established by gold, the silver buyers piled on. And we have seen in the last 90 days how dramatic a silver move can be. Again, in my experience, although gold moves first, and gold is the asset of choice for fear buyers, for insurance buyers, when silver moves, it moves further and it moves faster. So silver is really the metal for the speculators. Myself, I'm towards the end of my career. I'm more a fear buyer than a greed buyer. So my own portfolio emphasizes gold because I'm interested in the security of my purchasing power rather necessarily than increasing my purchasing power. Although I think that my own purchasing power is going to increase dramatically, as it already has, as a consequence of my participation in the gold equities, gold and silver equities. So we've decided, or pardon me, we've shown historically that gold moves first and then silver moves. Similarly, gold moves before the precious metals mining stocks. It's important to know this. It's important to note that the move that we have seen of late in precious metals mining stocks is completely consistent with history. The people who buy gold to begin with are insurance buyers. They're not investors. Investors move into the equity markets, and they move into the precious metals equity markets after the increase in the metals prices has improved, first of all, the income statements of the gold producers and later the balance sheets. A move in gold from $1,100 an ounce to $1,900 an ounce does a wonderful thing for companies' income statements. The price that they sell their product for increases rather dramatically, and their costs don't go up as fast. So the margins that they enjoy as a consequence of the increase in the precious metals prices begin to show up 6 months out, 9 months out. Similarly, as this free cash flow comes in, invariably it improves the balance sheets of these companies. They use it to pay down debt, they build cash cushions, and we have seen precisely that in this bull market. The incredible margin increases that we saw among the producers, first of all, the Australian producers, and later the North American producers, has of course done wonderful things to the income statements. EBIT, which is to say cash flow doubling or in some cases tripling. And that cash has found its way onto the balance sheet. So now we have a circumstance where free cash flow yields in the industry are very high, and the balance sheets are extraordinarily stout. Large cash balances, which means the ability to return capital to shareholders, the ability to grow the company, the ability to engage in merger and acquisition activity, a very, very wonderful circumstance. One thing that I'd like to draw attention to right now, because it's different than prior bull markets, has been the way that the precious metals mining equities work, which is to say the patterns that they follow, has begun to change. In prior bull markets, and also in recoveries, mere recoveries from oversold bottoms, the markets moved in predictable fashion. Gold moved first, of course, which happened this time. But what happened next was that the best of the best moved, which is to say the largest companies, the most liquid companies, the companies with the best balance sheets, the companies with the lowest cost of capital. And that happened too. Historically, what happens is that a valuation gap builds up between the best of the best and then the rest of the rest, which is to say smaller companies, single asset companies, smaller producers don't go up in price as fast as the largest companies, the best of the best. And two things happen. Some investors move down market. They take the gains that they've enjoyed in the best of the best, and they look for relative values among smaller companies. And if the valuation gap persists, merger and acquisition activities take place, where the largest and finest companies use their relatively low cost of capital to take over companies with lower share prices or a higher cost of capital. And finally, after 2 years or 3 years, the bull market moves all the way down to the exploration companies and the juniors. This time, for the first time in my career, the bull market seems to have moved from the best of the best all the way down to the juniors. My own belief is that this is a consequence of the phenomenon that you and I are experiencing right now, which is to say social media. The information about the gold industry is no longer introduced in a top-down fashion, by the popular media and by the investment banks. There is an awful lot of peer-to-peer discussion about precious metals mining stocks and exploration stocks, to the extent that we have seen a bull market which, for the first time in history, has skipped through the normal progression, moving all the way from $30 billion market caps all the way down to $30 million market caps simultaneously. This is new in my life, and I'm frankly interested in it. I don't have any particular thing to tell you in terms of how to play it, but I do want to point out that this is very, very normal. Let's talk about some other things too, because we've seen some precipitous declines recently. And I want you to know that in my experience, these declines are normal and natural. If you look at the Barron's Gold Mining Index, when I send it to you, you will see that declines in precious metals equities prices between 15% and 25% are common in prior markets. These are cyclical declines in secular bull markets, and they can be expected to continue. And in fact, I would suggest they can be expected to be exacerbated by increasing amounts of machine trading. On an intraday market, an awful lot of the trading that takes place in every investment class takes place between, if you will, dueling computers that are more motivated by technical analysis and by trends than they are reality and fact. And the consequence of that is that you're going to see increasing volatility, I would suspect. So understand that you are going to see sometimes breathtaking cyclical declines in secular bull markets. One example of how steep and how unnerving these declines can be is offered up by the 1970 bull market. Between 1970 and 1975, the gold price increased from $35 an ounce to $200 an ounce, a very handsome 600% move. And as that move happened, as a consequence of the price action, people's addiction to the narrative, their belief in gold increased. But in 1975, there was an increase in U.S. interest rates and an increase in the strength in the U.S. dollar, and the gold price fell from $200 an ounce to $100 an ounce. That is to say, a 50% decline in the metal, not just in the equities, which tested, of course, the faith of many of the previous faithful. And literally thousands of investors were shaken out of a gold bull market by a 50% cyclical decline in the secular bull market. And the consequence of that is they missed a 5-year period where the gold price increased from $100 an ounce to $850 an ounce. So for those of you who want to play this game, understand that you're going to have to absolutely positively fasten your seatbelt. Now let's talk about two bull markets. I believe we're in the first, which is to say a precious metals bull market. My own personal belief is that as a consequence of a bunch of economic trends, but importantly, as a consequence of a 10-year recovery from the 2008 liquidity crisis, that the economy has been overheated for a substantial period of time, a bubble, if you will, that was burst by COVID-19. My own belief is that even without COVID-19, that after a 10-year bull market, credit-driven bull market, we needed a period of economic slowdown. 10 years, from my own experience, is a very long recovery indeed. That was punctuated, of course, by the COVID-19 slowdown. And it's my personal belief, although I'm not an economist, that we're going to have a period of economic slowdown worldwide that lasts between 2 and 4 years. And the consequence of that is that natural resource materials other than precious metals, think copper, think zinc, think nickel, think oil and gas, think things like that, may be challenged in the next 2 to 4 years. They are economically sensitive. Now, understand that these commodities don't have to go down because many of them are being sold now at a discount to what it actually costs to produce them. But if I'm right, if we continue with a slowdown associated with industrial materials, we are setting up one of the greatest resource bull markets of my life. You see, as a society, we have underinvested in the stuff of life. We've underinvested in copper. We've underinvested in nickel. We've underinvested in agricultural materials, agricultural supplies like phosphate. We've underinvested in oil and gas. And when you balance supply and demand by reducing investment, which reduces supplies, when the balance of supply and demand comes back into balance, and the industry and the pricing begins to tighten, the industry can't increase unit production to meet the price signals because the business is capital intensive and cyclical. And what that means is that a commodity rally, let's say that the commodity prices should, in an ideal world, in a market clearing world, go up by 50 or 60%. In fact, what happens is they overshoot to the upside because the industry can't increase production. Anybody who wants any sort of confirmation of this should look back to the 1999, 2000, 2001, 2002 recovery in the stuff of life, in industrial materials. The oil price, you'll recall, went from about $20 a barrel to $130 a barrel. The greatest recovery, of course, was seen in the uranium markets, which went from $8 a pound to $130 or $140 a pound. But even the copper price recovery from 90 cents a pound, to $4.50 a pound, was a truly, truly dramatic circumstance. So my belief is that the people who are on this call likely experience two bull markets, which is to say a precious metals bull market, which we are in the early innings of today, and later an industrial materials market. It's important to note, as I say, that there's going to be a lot of volatility. It's also important to know that there are probably 2,000 companies worldwide, public companies worldwide, that purport to be in the mining business. And I would suspect that probably 10 or 15% of those companies are actually worthy of consideration, which is to say, out of 2,000 companies in the market, likely 1,700 of them merit no consideration. Now, that doesn't mean that in a bull market, where there are lots of newbies that don't have very much education, that these walking wounded, these 1,700 zombies, can't double or triple or quadruple in price. What it does mean is that the more you invest in yourself, the more you invest in your capacity and your discipline as a stock picker, the better you're going to do in this market, and the more that you are going to lower your risk. It's important that you note that. Towards the end of my discussion, I'd like to do a couple things, which I've done on Follow the Money broadcast before. I'd like to offer up the ability of people who are on the call to communicate directly with me. And what I'd like to do is, in fact, offer you an incentive to do that. Anybody on this call who wishes can go to a website, sprottusa.com/rankings. That's sprottusa.com/rankings. You'll find a web form. Fill out the web form with your existing natural resource portfolio, and I will send you back personally your companies ranked from 1 to 10. By the way, this isn't investment advice. I'm merely ranking the companies. I will comment on individual companies where I think that my comments have value, and I will include the Barron's Gold Mining Index chart, which puts the market that we're in a historical context. And in addition to that, I will send you a 100-year commodity chart, which I think backs up the two bull market thesis very well. So once again, go to sprottusa.com/rankings. Alternatively, you can email me. You can email me at rankings@sprottglobal.com. Rankings@sprottglobal.com. Brandon, I think that's it for what I have to say. I hope this is useful to your audience, and if it amuses them, I'm happy to answer questions. Yes? I do.
Rick, honestly, fantastic. I appreciate that so much, hearing the amount of experience and honestly wisdom that's coming out of you from all these different runs that you've been on. I was already, as you were doing that, I was going sprottusa.com/rate. I was already writing it in there. So I appreciate that. Look, like I said earlier, you're currently moving right now. This is time you've taken off work, and yet you still made yourself available to come on via phone call and go over this. I'm very, very appreciative of that. Joanne is, our whole team at FTMIG, IR Inc., everybody who at this conference or who will hear this later. Much appreciated on that. And we will absolutely get some people in there to get into that rankings. You'll see mine coming in, I promise, later today. And we do have some questions. If you're okay with that, we had a few questions come in that I'm sure they would love to hear your answer on what you can answer or not. Some of them are pretty specific. I love that, but I'll leave that up to you. But if you are okay with that, I'd love to jump over to some of the questions.
Let's do it. I need to say that people need to be a bit patient with regards to the rankings because, as you point out, I'm in the middle of a move.
Yeah.
And I answer each one individually, so it takes some time.
Not to worry, not to worry. I'm sure they won't mind if it's a day, a week, 3 weeks from now. If you answer, I think they'll be happy. So I appreciate
Great.
that. Well, why don't we just jump into the very first question here? And this is a simple, but also could be a hard question: precious metals or base metals, or both? Where's your opinion right now on those?
My own gut feeling is that precious metals move first, and so I would overweight the precious metals. If you're going to be in the base metals, understand that you're going to have, I think, a reasonably long wait. Now, that doesn't mean that a discovery in the base metals business can't move a stock. What it means is that you're not going to get the underlying beta from a base metals move. So people who want to participate in the base metals business either need to participate in a prospective discovery in base metals, or they need to buy the biggest and the best base metals companies, those that move first. My suspicion is that we have a tepid underlying performance in base metals for the next 2 to 4 years, although mercifully for me, in the year 2020, I've been very wrong. The copper price has done extraordinarily well.
Yeah, I think a lot of people had expectations of what 2020 would look like, and I don't know how many people had those expectations come to reality. Well, the next question is from myself, actually. And that's: you've been through 2 precious metal bull runs in your past. Today is August 12th, 2020. Do you have similar feelings today that you did before or during those other 2 bull runs? Where do you think we currently are now compared to the past 2? You touched on it a little bit in your presentation, but just a gut feeling of where you think we are.
My first bull market, I was a very young man, and I drank the Kool-Aid. The increase in precious metals markets made me more rather than less bullish, which is to say the euphoria around the price move justified the narrative. So I would describe myself in the period of the 70s as being much more ebullient than I am now. I've been punished on several occasions since I was a young man, which has made me somewhat more constrained. I will tell you this: I have never seen a circumstance where the economic backdrop for gold has been as good. Negative interest rates, quantitative easing, no willingness on the part of either the political elites or, frankly, the voters to counteract negative real interest rates, to counteract debt and deficits. It seems to me that people have to buy gold out of self-defense, not out of greed, but rather out of fear. And I don't see any circumstance, personally, that will cause the gold bull market to come to an end, other than a gold bull market that goes too fast, too far too fast. In a normal circumstance, I would say that we are in the early innings of the game. But my suspicion is, given the political reality in the United States and around the world, that this game will go extra innings.
Very well put, and in baseball terms that anybody, especially south of the border, can understand, but north as well. We like our Blue Jays, so no, I appreciate that. And it is, you look at all those different things. It's just incredible how much of the macroeconomic world and environment right now is pouring into this. So very, very exciting stuff there. The next question here is, politically speaking, if Biden gets in, where do you believe that leaves the precious metals market for the mining industry, et cetera? I've heard from a lot of people, particularly shareholders, who think the sky will fall should this happen.
I'm going to anger a lot of your listeners, but I regard Biden and Trump as Tweedledum and Tweedledummer. I think they're interchangeable. Now, the truth is that a Biden election will cause the sort of country club Republicans to panic, and that might drive more buying into gold. But it's important to note that under President Trump, the deficit in 1 month exceeded $800 billion. There is literally no constituency available in the United States that cares at all about sound currency. The difference between the Democrats and the Republicans with regards to debt and deficits with regards to negative interest rates, with regards to quantitative easing, the difference between the two of them wouldn't buy enough dynamite to blow them to hell. No difference whatsoever. The psychological impact of a Biden election could be important, and it could be very important for the broad stock market. The suggestion that Biden would like to institute a wealth tax, as an example, and change the nature of the tax code means that the impact of a Biden election on the broad stock market, including, by the way, big tech, could be ugly, but you're getting me out of my own field of expertise. Neither party, I think, has any interest in fiscal sanity. The truth is that the measures that you see right now, the measures that are popular in a democracy, constitute a war on savers by spenders. And spenders are more numerous than savers. The libertarians have a wonderful lapel pin that says a democracy is 4 coyotes and a lamb voting on what's for lunch. If you are the saver, you know that you are lunch under a Democratic administration or a Republican administration.
Yeah, very well put. I don't think they do understand that whatsoever, so it'll be interesting to see, but I appreciate that one, the answer there. This next one is coming from Jason. At the end of the 2020s decade, what commodity do you think will have performed the best during the bull market in commodities? Is it gold, silver, copper, uranium, or other?
I think the surprises will be delivered by natural gas, which is very, very cheap and very, very useful. And nobody expects it to do anything, which is one of the reasons why I think it will outperform. I also think uranium will do extraordinarily well. I can't tell you when, but my suspicion is that the production declines that we're seeing in the uranium business will generate 5 years from now, 6 years from now, some truly stupendous gains. Most of your listeners won't be prepared to wait 5 or 6 years. But the truth is, given that the question was asked me about the entire decade, I think you look to that. I think another place that you look to is probably potash, industrial materials. There has been a real slowdown in nutrient application worldwide at the same time that there's been an oversupply of potash. And productive capacity in potash has begun to decline. But the truth is that there's 7.5, 7.6 billion of us on Earth, and we all want to eat. By the end of the decade, the green revolution, the thing that feeds us all, will require much larger nutrient loads. And then finally, for your listeners who are American, water. Water will be the commodity that really truly performs through the decade. Now, the truth is that water is often price controlled politically, which is why many parts of the country, say New Mexico, Arizona, Colorado, California, perhaps Nevada, will, for some users, run out of water. But the investment implications associated with the political allocation of water are very, very, very profound.
Yeah, absolutely. Oh, sorry.
No worries. Keep talking. I'm running an errand, so while I'm talking to you, I'm attempting to multitask.
Not to worry.
An old man.
I was just going to make fun
fun
of my own country by saying, "Don't worry, I'll just come over here and we'll give it to you pennies on the dollar, like we're already doing."
No, I think that's the point. I think that the sector that if you give me the rest of the decade that will really, really, really surprise people is the Canadian natural gas sector, which is basically free now.
Yeah, absolutely. Well, I noticed you said uranium, so I'm going to go with this this question here from Terry. I know we've spoken with Terry on some of our podcasts before about uranium, and he says, "I'm fully invested in uranium. Should I sell some of these positions to enter and to buy gold and silver positions, or will it be better rewarding by staying in uranium?" Clearly, I'm speaking to the choir. You know that obviously can't make buy sell recommendations, but for someone who's in uranium, should they be looking to take part in gold and silver with some of those some of that capital potentially?
This is not individual investment advice. I can only say that in the next 2 years, money will be left on the table that doesn't have some exposure to gold and silver. The pace of the uranium price increase will be a function of the pace of Japanese restarts. And the very slow economy that we're experiencing worldwide means that consumer demand for Japanese manufactured goods is less, which means that the need that the Japanese have to restart their reactor fleet, and if you will, goose the uranium price, is delayed. If, as I suspect it might, it takes a year and a half or 2 years to see real price movement in uranium, many of the uranium juniors will have to go back to markets to raise survival capital. So although I have a decent sized position in uranium now, I'm keeping some powder dry personally to participate in an equity refinancing trend if, as, and when that develops.
Very interesting. Well, I'll do a very quick follow-up question on that. Same individual from Terry. Is there any truth to the rumor that Sprott may be offering a uranium equities mutual fund? If so, are you hiring?
We have no comments on that other than to say that we have looked at a uranium ETF, and we don't expect that there is broad enough liquidity in the sector to support an ETF. We are actively looking at a uranium portfolio that would populate segregated managed accounts. It is unlikely in the near term that we would offer up a uranium mutual fund, but rather would construct uranium portfolios on a bespoke basis for individual investors. We have very deep talent in the uranium business in terms of financial analysis, access to information, and also engineering and geological staff with uranium expertise. And I personally have a lot of experience in uranium markets. In fact, the uranium bull market that came about in the 1998-2006 period was the most dramatic financial event of my own life. So I look forward in my declining years to participating in another one.
Absolutely. You and I have actually had a rather detailed conversation on this. I just text Wes, who deals with all of our content creation and producing, and he's the reason why I sound and look good on these things. It's all him. But we had a really long conversation. So I was just asking him where that video is. I could share with people as well, because you spoke about how that was really your large beginning was in uranium, and how you did very well on it. So we'll see if we can share that as well. That was a very good conversation we had. The next question here, Rick. Oh, sorry.
No, I was just saying thank you for the kind words.
Absolutely. The next question here is, if you are a small retail investor with, say, $5,000 and you are new to investing, what would be the safest way about investing in gold and silver?
The safest way to invest in gold and silver is to buy physical gold. That's the safest way. It isn't the way that necessarily will be likely to make you the most money. But the safest way would be to buy physical gold, or if you are a U.S. investor, to buy one of the New York State Stock Exchange traded Sprott physical products, the Sprott Physical Gold Trust, the Sprott Physical Gold and Silver Trust, or the Sprott Silver Trust. I can't give individual investment advice, which is to say what the best way is, but the direct answer to the question, the safest way is to buy physical gold or buy a surrogate for physical gold. Understand that the safest way will not necessarily be the best performing way.
Oh, absolutely. And I appreciate that. The investor, I do know them. They are from the United States. So that could potentially be something that they want to look into. So I appreciate that. The next question is coming from Hashem, and it's asking, how can companies address their undervaluation at a time when equity valuation is lagging the gold price increase?
Could you repeat the question? I didn't get all of it. I'm sorry.
No, that's okay. He asks, how can companies address their undervaluation at a time when equity valuation is lagging the gold price increase?
Well, I would argue in the beginning of that 80% of the gold juniors have no value whatsoever, and so they're chronically overvalued. To the extent that companies have a legitimate story to tell, now you have to get out and tell it. 10 years ago, you didn't have to do that. In fact, you couldn't tell it. There was nobody to tell it to. Your story got told by popular media, or your story got told by investment banks. But today, participating in discussions like this is a wonderful way to build a retail constituency, particularly for companies that have smaller than a $1 billion market cap. which is to say the small producers and the juniors. The truth is that we've seen a number of companies, even newly constructed companies, that have gone from having 10 million market cap to 70 or $80 million market cap as a consequence of effective promotion. The ability that companies now have to build a constituency by participating in social media is something that's occurred for the first time in my career. And while I don't really have a handle on how it's going to play out, I'm very interested and excited by the phenomenon. This sort of peer-to-peer discussion means that companies can build a shareholder constituency by effective and honest communication that is in effect free, other than requiring effort and skill.
Very interesting. Rick, that goes really, really well with Miko's question here, where he's asking, is it important to pick a company with a good presenter, even if they have a mediocre project?
I would avoid mediocre projects. I think that while it's true that a mediocre project with a good presenter gives you a good trading opportunity, those circumstances always end up in tears. It is important to choose a company with a great management team, not just a great mouthpiece. A great management team will hire a great mouthpiece, but great mouthpieces only give the investors trading opportunities. You need a project, but most importantly, you need a team. You need a team that has been a prior success, and you need a team that has been a success in an activity very similar to the activity that they're undertaking now. As an example, if your CEO says to you, I have been a success in gold mining because I operated a gold mine in Archean terrain, 2 billion-year-old rock, in French-speaking Quebec, but the current activity in the current company is exploring for rather than producing gold, let's say copper gold, porphyries, in accreted terrain, 15 million-year-old rock rather than 2 billion-year-old rock, in Spanish-speaking Peru. While it's true that your CEO has a track record of success, the track record of success is not immediately related to the task at hand. So the most important thing to look at in small companies is the quality of the management team, and the quality of the management team in functions that are very similar to the task at hand. That high quality team will, over time, acquire a high quality spokesperson. There is a different discipline, one that I'm lousy at, which has to do with understanding the power of a narrative on a market. That is, if you will, trading bullshit. And I'm not disparaging it. It's just a skill set that I don't have. Understanding the power of a narrative on a market and understanding the marketing plan, understanding how the mouthpiece delivers more buyers than sellers in the near term is a time-honored trading technique. The truth is that I myself, as an analyst, am not really clued into popular culture. I don't own a television set. Those of you who have seen me live know that without my wife's help, I can't dress myself. So there is probably nobody in the world that is less adapted to trading strategies around monetizing a narrative than I.
Yeah, and it's very interesting how much that's affected it, where so much of the fundamentals we've been on for decades are almost, you can almost throw them out the window, because now it's all about how many people can you get talking about it. It's all about the pump. It's all about the momentum. It's all about it. It's all about the tweets from individuals.
Brandon, remember this in the chart that I'm going to email you and your friends. What you will see is that the backside of a bull market is just as steep as the front side, and a lot less fun. And it's the cannon fodder, the trading stocks that move the furthest, the fastest, the ones that have no value whatsoever. So while I'm not trying to say that trading a narrative isn't an interesting thing to do, if you have that capability, understand that doing that is not the same as investing. It's monetizing speculator stupidity. There's a lot of speculator stupidity out there to monetize, but it's a very, very different art form.
Absolutely, 100%. It's pretty much just, a classier way of gambling, if you want to even call it that. But hey, right. Sometimes you strike it rich there. But we've got 3 more questions that are in here. Is it okay if I ask the last 3?
Yes, it is.
Beautiful. Then I'll let you go back because I know you're moving, you're errand running. I appreciate this. So we'll do the last few here really quickly here.
Great.
Rick, great name, is asking, Elliott Wave is very bullish on gold and silver. Elliott Wave has been pretty good in predicting precious metal prices in the past. What do you think about Elliott Wave today? The individual or the I'm not sure if he's asking about the individual or on his how bearish he is on gold. I think we should go more so on how bearish he is on gold. We'll stick that as the question.
I need to say that I am not by nature a practitioner of technical analysis. And so while I understand the validity of the question for people who understand it better than I'm ill-equipped to comment. I'm not degrading the question. I'm just saying that it's not my place to comment because it's not my area of expertise.
No, I appreciate that very much. At the end of the day, I'm sure he'll appreciate that as well, instead of just spewing out an answer for the sake of spewing out an answer. Miko's here, and he's asking how hot of a commodity is platinum and palladium given EV starting to take over? Is this just a Western bias when the rest of the world might not even have traditional cars?
I think it is a Western bias. Platinum and palladium are used for catalytic conversion. And part of the reason why people are attracted to platinum and palladium has to do with the efficacy of platinum and palladium in internal combustion engines. And my belief is that the demand for internal combustion engines will continue to grow all the way through 2035. The other attraction that you have with regards to platinum and palladium is the idea that they are only produced really in economic quantities in South Africa, Zimbabwe, and Russia. So there could always be a supply shortfall. Now, you need to understand that they're economically sensitive commodities, and a weak economy means weak car sales globally. So the next 2 or 3 years could be challenging.
Yeah, very well said on that aspect. The next
I have
question here,
time for I only have time for one more question.
no problem. This will be the last one here because the other one is talking
great,
about Robinhood, which again is outside the wheelhouse there, social media related. So we'll go with Joanne's question here. It's the last question for today, and it's between the politics, the civil rights unrest, and COVID, and this is worldwide, by the way, not just in the U.S. What do you tell people in general when deciding on investing in stocks or in physical materials?
The advice depends on the individual investor. There is no one size fits all. With regards to precious metals, it's important to note that it isn't the circumstance. It isn't COVID. It isn't politics. It's the policy response to the circumstance. It's quantitative easing. It's artificially low interest rates. It's populist politics that matters. There are different answers with regards to general market securities. And I realize that your listener would like a one-size-fits-all answer. But in my experience, my 45 years in capital markets, there isn't a one-size-fits-all answer. Further, there isn't any certainty at all. There's merely a range of probabilities. So while I understand the nature of his or her question, I would sort of like to leave them with the sense that there aren't any answers. There's merely a range of probabilities.
Absolutely. Well, Rick, I appreciate it very much, as do all of our attendees and those who will be seeing this. We'll be looking out for that email, and we'll be sending it to all of our attendees for this as well. Once again, Rick Rule, much appreciated. Much appreciated, my good man.
Thank you very much. Hopefully the next discussion we have will be under more technologically advanced circumstances. Thank you for your time.
Absolutely. Take care now.